In this video, I am going to talk about setting a price for our products. In general, there are two approaches to setting our price, and the two approaches are essentially you start with the cost and then you work your way up to the price that you're going to decide to sell. Or the other approach is you determine the price and then you figure out how much you're going to make given the fact that you're forced to sell at that particular price. Okay, so the two schools of thoughts are price setters, and price setters are situations where the manufacturer is delivering a very unique product, right? So there's really no competition. There's nobody selling a similar product. It's a very unique product. It's one of a kind. It could be a brand, right? Apple is a great example of a brand. There could be high barriers to entry, meaning it could be really hard for competitors to come into the market. And Apple, again, is a very good example because it's not easy to just decide to sell cell phones, right? There is a tremendous amount of capital investment that needs to take place in order for a company to just start randomly selling cell phones. And because of that, if you do sell a cell phone that's very unique, you have the opportunity to set a price for that particular product. Alternatively, there are price takers. And that's usually the case when there's a lot of competition in the market. The product really isn't very unique. There's no brand associated with the particular product. And then there's a lot of people selling very similar products. And I always use like a can of beans as a perfect example, right? So it's really hard to set the price for a can of beans when there's a going price. There's a lot of individual companies that are selling beans, etc., etc. Okay, so companies can be price takers or price setters. Okay, price takers generally have less control over setting the price. That's what we said. Price setters have more control. We just went through that. Therefore, price takers, they usually start with target pricing and then work their way down. Whereas price setters use a cost plus pricing approach. Okay. So let's talk about the two approaches, target pricing and what that analysis looks like, and then cost plus pricing. And let's look at what that analysis looks like. Okay. So first, cost plus, right? So we deliver a very unique product. We have the ability to set our own product, the price for our own product. So we're typically saying, like, how much does it cost for us to make our product? Whatever that cost is, we're just going to tack on our desired profit, and that'll be the price. Okay. So the steps would be, first, we're going to determine the total cost per unit. How much does it make us to make our product? How much does it cost for us to make our product? Then once I know the total cost, I'm going to divide the total cost by the number of units, and therefore I'll get the cost per unit. And then once I have the cost per unit, I could just tack on my markup percentage. And then the selling price is going to be the total cost of the unit times, or plus, I should say, the markup cost. Let's look at this in an example. So again, here's our information. We have direct material, $20 per unit, labor, $16 per unit, overhead, $8 per unit. Then we have variable SG&A of $6 per unit. Then we have our fixed costs, $140,000 times, in addition to $140,000 of overhead, manufacturing overhead, we also have $60,000 of SG&A. Okay. So remember, the goal is to first really find how much is the total cost. Then second step, let's divide it by the number of units. Then the third step, let's tack on our margin, our operating margin, to the total cost per unit to set our price, right? So step one, we're saying in this particular example, we're going to sell 10,000 units and each one's going to cost us $20 material. So we have 200 in direct material, 10,000 units times our $16 per unit in labor, 160,000. Variable overhead, $8 per unit, like we said above, right? Times the 10,000 units, 80,000. Then we are going to include our fixed overhead, and therefore total product costs, 580,000. Then we're going to do our SG&A, and our SG&A, we said $6 variable times the 10,000 units. So we have 60,000 in variable SG&A. Then we also said we have 60,000 in fixed overhead for a total of 120,000 in SG&A. Therefore, total costs to make our product, in addition to selling the product, 700,000. Again, we're going to assume that we're manufacturing and selling 10,000, and therefore total cost 70,000. That's step one. God, total cost $70 per unit. Then I'm saying in this particular example, we want a 20% markup on the cost. So if it costs us $70, we want a $20 markup. We're saying we're going to mark the product up by $14. And so the sale price is going to be the total cost plus the $14 markup. And so we would set a price of $84. That is a price setter analysis. Alternatively, we can do the target costing method, right? So in this particular example, what we're basically saying is, okay, we know the sale price. It's going to be $80. We have literally no control over that, okay? The general price for our product, given the market, is $80 per unit. And what we want is we would like a $14 profit on every unit we sell. And therefore, we need to figure out, can we make this product for $66 per unit? That would be the $80 selling price minus the $14 target price. So, can we do it for $66? 66, which is the $80 selling price minus the $14 target profit. Okay, so what we would do, actually, I guess they're not even going to give us a fucking example. We just know theoretically. Our target cost, what I would say, right? What I would say is it's not going to be that easy. I bet you anything in the homework is going to be slightly more difficult. In the homework, what you'll probably do is figure out a target cost and then figure out if you can create a product at that particular cost. Okay. Variable cost method. This is really related to cost plus approach. And so what we're saying is there's a different way to figure out what the sale price is going to be. And we would call it the markup percentage. The markup percentage formula is target profit plus the fixed costs divided by variable costs. Okay. Then once I have my markup percentage, I can figure out what the markup per unit would be, which would be the variable cost times the markup percentage. Then once I know the markup per unit, then I can figure out the cost per unit, right? Sorry, the selling price per unit. It would be variable costs plus the markup per unit. So let's see if we can figure that out. Let's do markup percentage first. So first we would have to figure out our target profit. So target profit, 140,000. fixed costs. We have overhead of 140, selling and general administrative expenses of 60,000. So target profit plus our fixed costs, 340,000. Okay. Then we said the variable costs per unit. We have material, labor, variable manufacturing overhead, and SG&A for a total of $50. And then the units to produce, 10,000, and therefore total variable cost, 500,000. So we're going to divide 340 divided by 500 is going to give me 68%. That's target profit of 140,000 plus the fixed overhead and fixed SG&A divided by variable cost. Okay, 68%. Now, step 2, now I know the markup per unit. So if I know my variable cost is $50 per unit and my markup percentage over variable cost is 68%, then 68% times $50, $34 per unit. Then I have my variable cost per unit of 50 plus my markup $34 per unit. My sale price would be 84.